Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle, U.S. economist at Nasdaq, to discuss if recent data show signs of recovery in the banking crisis. Michael, it's great to see you as always. Welcome back to Trade Talks. And I know that your team has been following what's been happening within the banking sector and the impact to the overall economy. If we take a look at your first couple of slides here, is there anything that you see when you compare it to previous bank crises?
Right. So if you look back over history, the thing that jumps out between this crisis and the last few, at least, is the size of the banks involved. So at this point, if you look at the asset values as a share of GDP for the three banks that have failed in the last couple of months, it's nearing the size of the global financial crisis, where it was about 500 banks that failed, and the savings and loan crisis, where it was over 2,000 banks that failed. So it's much larger banks that have been involved in this case. But with the failure of First Republic, you do see that there's been some stress that's come out of the system. If you look at the Fed's liquidity programs that they have, the discount window and the bank term funding program, we saw the total borrowing from those programs drop by about half in the last week. And we know that that's mostly because of First Republic, because another line in the Fed's report has loans to banks controlled by the FDIC, and you saw that rise by about $60 billion. So that's a big chunk of the drop that we saw week over week there.
And part of the issue was with the banking crisis, what it would do to lending. Has anything impacting lending standards? Is it tighter or less than feared?
Right. So on Monday, we got the Fed's senior loan officer opinion survey, which occurred. The survey took place in April, so after the crisis began, and it was feared that it was going to be a pretty big jump in terms of tightness, so loans becoming less available. But we didn't see as big of an increase in tightness as feared. It's an incremental questionnaire, though, so it's looking at how much tighter it got this period versus the previous period. So we saw a broader share of banks tightening credit standards, but not as bad as feared. So that's a bit of a positive there. But there are two areas for concern where they also asked a question about what banks foresee their tightening over the course of the rest of this year, and they expect to see further tightening over the rest of this year. And then the second issue is that already going back to that chart, you see that where we were even prior to the banking crisis is about as tight as during past recessions.
And to wrap up here, what about small bank lending?
Well, so yeah, that's the interesting thing with basically what we saw from the survey, but what we've seen from actual lending. So basically what banks say that they're going to do and what they have done. And we have seen that small bank lending has actually been increasing for the last 4 weeks. So even though this crisis has been unfolding, banks have been, there's a 2-week period immediately after the beginning of the crisis where lending fell, but for the last 4 weeks, it's been rising, and large banks already reached a new high in their lending. So we've seen that return there. So some signs of positive developments where the liquidity crunch, a lot of it appears to have been because of First Republic, and then now seeing that the small banks have already returned to continuing their lending.
All right. Appreciate the insight as always. Michael, thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.